There's a retirement account move called Net Unrealized Appreciation that lets someone leaving their job turn a stack of company stock taxed at ordinary income rates into a tax bill calculated at capital gains rates instead, quietly saving tens of thousands of dollars completely legally. And your HR department, your 401k administrator, and most financial advisors will never tell you it exists. Here's the thing about leaving a job. You get an exit packet. Somewhere in it, in small print, is a line about your 401k. And almost everyone does the same thing. They roll it straight into an IRA. Automatic. No thought required. But if part of that 401k is company stock you got through an employee stock purchase plan, RSUs that vested into the plan, or years of employer matching, rolling it over the normal way can quietly cost you thousands of dollars the moment you eventually touch that money. Nobody warns you. The rollover paperwork doesn't have a box that says, "Wait, don't do that yet." So here's what's actually going on. Net Unrealized Appreciation, NUA for short, is the gap between what you originally paid for that company stock inside your 401k and what it's worth today. Say your employer put stock in your account over the years and your real cost was low, but the stock climbed. That growth, sitting inside a 401k, is normally a ticking tax bomb. Every dollar you eventually pull out gets taxed as ordinary income, the same bracket as your paycheck. But there's a separation from service rule, meaning the day you leave that job, that lets you move the stock, not roll it, directly into a regular taxable brokerage account instead. And when you do that correctly, you only owe ordinary income tax on your original cost basis, right now. The growth, the appreciation, gets taxed later when you sell at the capital gains rate. That's the whole secret. Let's put numbers on it. Say you're leaving your job with $200,000 of company stock inside your 401k, and your actual cost basis, what you paid in over the years through the plan, is $40,000. Roll it all into an IRA the normal way, and every dollar that eventually comes out gets taxed as ordinary income. At a 32% bracket, that's a future tax bill north of $64,000. But use the NUA move instead, and you pay ordinary income tax only on that $40,000 basis today, about $12,800. The remaining $160,000 in appreciation sits in a taxable account until you sell, taxed at the long-term capital gains rate, roughly 15%. That's another $24,000. Add it up and your total tax bill lands near $36,800 instead of $64,000. Same stock, same $200,000, a difference of over $27,000 just from knowing which box not to check. But here's where it gets interesting. This isn't some obscure loophole for hedge fund managers. This is written directly into the tax code, section 402(e)(4) for regular employees. Executives at companies that went public use it. Longtime employees at Coca-Cola, at manufacturing companies, at any employer that matches in stock use it. Financial advisors managing your rollover IRA make ongoing fees off assets under management. An NUA move sends part of that money into a brokerage account they may never touch. Nobody's forcing them to mention it. It's not illegal to stay quiet. It's just profitable. Now, the catch, because there's always a catch. This only works if you take a lump sum distribution of your entire 401k balance in a single calendar year, triggered by an actual separation event. Quitting, getting laid off, retiring, turning 59 and a half. If you've already rolled that stock into an IRA, this door is closed permanently. It only works while the stock is still sitting inside the old 401k, untouched. And it only makes sense if the appreciation is substantial enough to be worth losing the tax-deferred growth an IRA would otherwise give you. So somewhere between the exit interview and the rollover form, there's a decision that permanently determines whether your company stock gets taxed at your paycheck's rate or at the rate the wealthy pay on investments. Most people never even know the choice was there to make. And there's a related move, one that applies even if you've never held a single share of company stock, that can shrink a tax bill just as fast. That's the next file.